Canada's economy is in deep trouble. But that is not where the story ends, because when we talk about Canada, we can't escape talking about its southern neighbor. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And we're going to be talking about another central bank that looks likely to abandon its fight against inflation and turn its focus to economic growth. In this case, we're talking the Bank of Canada. But of course, when that happens, the signal that comes back to a conversation about the United States is an emphatic one. And so the question that we're going to be asking ourselves from a trading perspective, from a tactical perspective, is just how important this Canadian monetary policy announcement is likely to be for Wall Street itself, for stocks globally, for currencies globally, for commodities writ large. Because the signal hiding just north of the U.S. border here may well be the onset of recession. So let's begin with a bit of stage setting. Canada's GDP unexpectedly shrank in the third quarter. The expectation was that we'd get a slight uplift, but as it turned out, the annualized rate gave us an economy shrinking at a pace of 1.1% in the third quarter. Now, that is obviously a very eye-catching number. If we take a look at the last time we saw anything comparable, we were talking about the middle of 2021, right after the normalization following the COVID-19 pandemic. So we are looking here at a very acute decline. If we look at the PMI data that follows, this, of course, operates on the usual PMI logic. 50 is neutral. Above 50 is expansion. Below 50 is contraction. The further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. Well, the story here could not really look any worse. Everything is in contraction territory, manufacturing, services, and, of course, the composite of the two. What's more, it's the service sector, the largest part of the economy, that's feeling the most acute pain. Not only that, but that pain is the worst that it has been since the middle of 2020. So at this point, the economy is shrinking at a pace comparable with the two worst months of the early COVID outbreak, June and July. So we are looking at this point at a Canadian economy that is rapidly deteriorating. Now, at the same time, the story on the inflation front seems to point toward continued move in the direction that the central bank would like to see. In Canada, the central bank targets a range on the inflation front of 1% to 3%. The middle of the range there, of course, gives us a give or take inflation target of 2%. Now, in the red here is the 5-year break-even rate, which is the bond market's inflation expectation derived from taking the nominal bond yield, subtracting from it the real one, and so getting the magnitude as residual of the inflation adjustment to get from nominal to real, because, of course, real interest rates are just nominal rates minus expected inflation. And this break-even rate is that expected inflation number. So we can see in that the bond market's expectation for where Canadian inflation is going to be over about a 5-year medium-term window. Notice it has stabilized at the target 2%. So the markets think that the Bank of Canada is well on track to get to where it needs to go. Now, if this were the Fed and the target was exactly 2% or close to 2%, maybe there would be more of a need for some leeway here. But for a 5-year break even to stabilize at 2% when the target range is 1 to 3 allows the Bank of Canada to all but certainly declare some semblance of victory. Now, we say some semblance rather than outright declare victory because, of course, actual CPI registered at 3.1% at the latest reading. Now, there was a bit of an unwelcome pop in inflation over the summer. We can see here we got as low as 2.8%, then popped back up to 4%. Now we're down back to 3.1%. Notice that CPI here is lagged 2 months. So in that we are seeing continued stabilizing around the 2% reading on the break even seems to suggest that CPI has more room to catch up lower. It gets even more emphatic when we look at what's going on with the largest component of CPI, shelter. In Canada, housing and shelter make up, on average, for the past 20 years or so, 28% of the CPI basket. Now, of course, nobody knows actually what inflation is because the prices of things, depending on the thing, can be different and moving in different directions. So the way that inflation is tracked is people come up with a basket of the usual goods that consumers buy, right? Hence consumer price index. And they track that basket over time and track the cost of that basket, and that's what inflation is. We can see here, then, what happens when we look at how 28% of that basket, housing, makes for a relationship between the price of housing and overall inflation. And we can see here that house price growth here in year-on-year terms, so analog to how we typically measure CPI, seems to be leading overall CPI by almost a year, 10 months. And that's because, of course, housing tends to be relatively slow, and so the turnover is relatively more prolonged than you would see in other assets. And so you can see something really take a while in housing before it feeds elsewhere. But what we can see now is that the peak in housing year on year, if one were to lag CPI by 10 months, seems to generally line up, and that there is a lot more declining to be done if the lead-in continues to hold. As a matter of fact, for the past 7 months, house prices have fallen at an accelerating rate in Canada. They were down almost 1% year on year a month ago and down 0.9% in this latest reading. You can see the orange line here now below zero, which means if this is leading into where CPI is ultimately going, then it's deflation that should be a concern, not inflation at this point. So we take all of that together, the anemic growth, the progress, and indications of continued progress on inflation, and it makes sense that when the Bank of Canada meets tomorrow, they are not going to raise interest rates again. As a matter of fact, if we look at the way that the policy outlook has evolved since the last time that they met in late October, we can see a very pronounced dovish shift. Now, this is happening for reasons domestic and otherwise. We, of course, know that the Fed is the quintessential central bank to be watching for the global cost of money because the US dollar is so ubiquitous as a unit of commercial exchange. We say this all the time here on Macro Money, but let's remind ourselves, the Bank of International Settlements guesstimates that just under 90%, around 88%, of global monetary transactions are settled in US dollars. And that's because, of course, the interbank correspondence system for transferring funds from bank to bank, the SWIFT system, is a dollar-based system. Most global commodities are quoted in US dollars, and the US dollar is by far, by a long, long mile, the most liquid of any other currency. And so it makes sense that the US dollar would have this leading perch as the go-to unit of commercial exchange. So when the Fed goes and increases the cost of borrowing dollars, what it's doing is it's increasing the cost of borrowing for any kind of economic activity everywhere, not just in the US, but globally. And so when the Fed told us in the very last policy meeting, the November 1st policy meeting, that they're probably done with rate hikes. And then over the course of November, what we saw is loud celebration across financial markets, stocks higher, bonds higher, dollar lower, all around this idea that the Fed is finally done. There was a dovish adjustment in all of the major central banks' policy expectations because there was a general downshift in interest rates led by the Fed across every major geography, save for perhaps those that are so disconnected from the global economy as to not feel the impact, like, let's say, North Korea, perhaps. So we look at a shift here that is clearly very dramatic in Canada because of Canada's own weakness, but also, of course, because the Fed has set a tone. And so what we see is that relative to the last BOC meeting, there has been a very dramatic shift lower in the curve. We were looking, as we can see, back in late October, at rates holding unchanged, perhaps for 6 months. Now it looks like we're already looking at cuts when we look at the same time frame here. So you can see we were looking at standstill at about 5% here. You're already down 40 basis points a month later. So what this is telling us, of course, is that rate cuts are coming sooner. And looking at where this path was going to end up to where it's expected to end up now, it's going to end up lower. So clearly a dovish turn in policy expectations. And we can see that here in terms of what is on the menu for this meeting and thereafter. A mere 6.5% chance of any change one way or another. And indeed, there are no positive numbers on this table whatsoever. So any change likely from here is seen as a cut. 6.5% chance of one at this meeting. It becomes better than even odds of easing by March, 72% chance of a cut right here. And that's by March, not in March. In March, it's 49%. By March, it's these probabilities taken in a cumulative way. So 6.5 and 6.1 and 49.3 add up together to almost 72% chance of a cut by this meeting. We can see the cut is fully baked in, so one cut already on the menu for April or by April, and a 41% chance of a second one. As we look out through the end of the year, we can see 3 cuts by the tail end of the third quarter, 4 as we get into the fourth, and a further 23% chance that we're actually going to get a 5th. So rates are seen coming down from 5 now to 4 before the end of next year. And that, of course, is a tremendous amount of easing. Now, that being endorsed by the Bank of Canada as it comes out and says, yes, growth is weaker, so we might have to really start to lean into an easing cycle here. Now, of course, they're not going to say this in absolutely straightforward, absolutely overt terms. They still have to pay lip service to the fact that CPI is at a 3.2 or a 3 handle here. So they do have to pay lip service to expectations of inflation not getting out of hand. And so surely we're going to get all the requisite disclaimers about holding higher for longer and being focused on inflation. But the Fed has the same mantra now for months and months, and nevertheless, the expectation for Fed policy has turned a lot more dovish because that part of it is status quo. We've heard all of that. It's been discounted months and months ago. It's the slight tweaking of the language to allow for more of a dovish tilting within the usual disclaimer set that the markets are picking up on. That's the change. And it might very well be the change that appears in Canada. Now, needless to say, we've talked about all through November, the markets cheered lower interest rates because that was supposed to be good for growth. It would help to paper over whatever economic weakness was underway. All of that clearly a cause for celebration for markets last month. But this month, it seems like we're increasingly starting to consider, well, why are all these central banks suddenly angling to cut rates? Because surely it isn't for good reasons. Rates aren't generally cut because things are going well. It's because things are starting to look ominous. And so if last month was about, let's consider this a good thing, yes, the economy is weak, but oh, look, central banks have seen the light and they're going to give us cheaper credit. Now, the focus seems to be, well, the cheaper credit is coming because the growth situation is weaker, and that weakness is becoming increasingly acute. We saw this on display in spades just over the past 24 hours. The Reserve Bank of Australia made its policy announcement, and it sounded the initial cues of a dovish retreat. Now, of course, the Australian dollar fell, as one might expect. But also Australian stocks declined. Typically, you'd think stocks would cheer lower interest rates, and have been, as a matter of fact. But now, it's not the lower cost of borrowing that is apparently in focus for investors. It's the malaise in economic growth that demands that lower cost of borrowing, and the negativity therein for corporate earnings and the economy in general that people seem to be focusing on. And so Australian stocks were not able to rise on a dovish central bank. On the contrary, they fell almost 1% by day's end. A similar lens applied to Canada might give you lower stocks and a lower Canadian dollar locally. But that's not where this story ends by a long shot. Because if we look at what made up that 1.1% decline in GDP, we can see that it's netted out from actually positive growth in Canada to the tune of 1.3% annualized rate, but a stark 2.4% annualized decline in external demand, which is a tremendously powerful signal because when we consider where external demand in Canada comes from, it comes from the U.S. As a matter of fact, the latest numbers here as of September show us that the U.S. consumes 79% of Canada's exports. So when we see that the weakness in Canada's economy is primarily the unraveling of external demand, what we're watching is U.S. demand coming apart. And the beginnings of an early signal of recession in the world's largest economy. Yes, of course, the pain in Canada is acute on its own merits. But the situation flags what is a much bigger concern for global growth writ large. Because what Canada is seemingly experiencing is a window into what's happening in the United States. And just to remind ourselves, the U.S. is nearly a quarter of global GDP by itself. The Eurozone is an additional 12%, and China is 16%. Together, they are 50% of global GDP before we account for the fact that economies like Canada are dependent on one of the three, in this case, the U.S. Central Europe is equally dependent on the Eurozone, as is to a large extent Nordic Europe. Australia is equally dependent on China, as are a whole host of emerging market economies from Latin America to Southeast Asia to Africa. And so the impact of these three is understated when we say that they are 50% of global GDP, because actually any growth to be had in the other 50% depends in large part on these three, because the other 50% is in large part a set of vendors for the three large ones. So how are things going there? Well, we can see here the Eurozone is already in recession. The composite PMI number here, again, the logic here is 50 is neutral, under 50 is contraction, above 50 is growth. Well, in the Eurozone, we're very much in contraction territory. In the US and China, we're effectively at standstill, just a hair above 50. Worse in China, on latest reading, than it is in the US. Netting out to near standstill globally. This is the latest set of composite PMI numbers taking the whole pie together, emerging and developed markets. And we can see 50.4 on the composite index. The global economy is essentially stalled. Now, looking back here, if what these numbers out of Canada and the dovish central bank to go with them are taken and filtered into this dynamic, well, it probably hints that that U.S. line is going lower next, which makes a global recession very difficult to avoid, especially since China, the third pillar here, is, among other things, a vendor for the U.S. and the Eurozone, and is in part, as anemic as it is, despite reopening here in December of 2022 following the COVID pandemic, yet unable to build any kind of meaningful momentum and right back down to essentially standstill after a brief pop in the first quarter of this year, is because China is itself a vendor, the middle of the global supply chain for the U.S. and the Eurozone. And growth there peaked ages before China reopened. We can see dramatic catch-up growth in both the U.S. and Europe, very elevated growth numbers here, approaching 70 for the peak in the U.S. You can see here surging out of contraction territory as stimulus and economic reopening come together, and the peak is in May of 2021. In the Eurozone, the peak is a little bit lower. Stimulus in the Eurozone was a little bit more modest than it was in the U.S., so that makes sense. It also came a bit later, so the later peak and the lower one makes sense. But again, we're looking at significant, sharp catch-up growth here. By the time China comes around, that has petered down to very, very little growth, if any at all, depending on where you look. It's somewhat returned to positive growth in the U.S. here. But as we get this sort of middle of the supply chain economy coming back on and saying, oh, well, we'd like the demand back. Well, that demand isn't there. So there's a bit of a feedback loop here. Yes, it is the U.S. and the Eurozone and China that are most important, and the other three, or the other 50% of the pie is dependent on those three. But also, China is dependent on the U.S. and the Eurozone. And if the Eurozone is already in recession and Canada is screaming, we need to start thinking about rate cuts, the situation here is terribly anemic, well, then the U.S. is probably, if not in recession yet, then certainly getting very close to one. And that, of course, feeds into China as well. So you end up with a situation coming out of this Bank of Canada announcement that may very well extend well beyond what we're seeing in Canadian assets themselves and strike Wall Street, strike the major growth-geared commodities, be they copper or crude oil, give a lift to anti-risk currencies that benefit from liquidation of risky assets, the Japanese yen and the US dollar, boost bonds, hurt yields, and perhaps weigh heaviest on those currencies that are the most anchored to the global business cycle, the Australian dollar, the Canadian dollar, which have been a little bit better supported recently. But as we learned from the Australian dollar's RBA experience overnight, perhaps not for long. And that is macro money for today. We're going to be watching this situation in Canada very closely and seeing the Wall Street response. A dovish central bank may well be bad news for Canada and that business cycle, but it may be bad news in a much more broad and macro way. Macro money itself, of course, will be back tomorrow. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at what happened in markets on a given day and what next steps might look like. I'm back on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and opining on the platform formerly known as Twitter, @IliasPivak. Thanks very much for joining. Happy trading. See you tomorrow.